There's this guy who put $300,000 into a 529 plan for his daughter in 1998. Smart guy. Did everything the financial advisors told him. Tax advantaged, diversified, responsible. Fast forward to 2024, she graduates, and the account has grown to about $600,000. Not bad, right? Except she got a full ride scholarship. And now that money is trapped. She can either pay a 10% penalty plus income tax to withdraw it, or she can transfer it to another family member and hope they go to college. Meanwhile, his buddy put the same $300,000 into a different structure, one nobody talks about at dinner parties, and his kid borrowed against it at 24 to buy a triplex. No taxes, no penalties. The money kept growing while she used it. Same starting point, completely different financial bloodline. Here's the question nobody asks. What if the entire framework you've been sold about setting up your kids financially is designed to benefit everyone except your kids? I'm going to break down the exact investment structure I've built for my own kids. Not theory, not something I heard at a seminar. The actual system I've implemented with real money, real structures, and real estate. And I'm going to show you why the conventional path is a trap that keeps wealth locked up when it should be multiplying. Because here's what I've learned. After 10 plus years running businesses and being surrounded by accountants who actually understand how money moves, the difference between generational wealth and a decent nest egg isn't how much you save. It's how many times that same dollar can work before you die. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data link in the description. Think of wealth building like plumbing. Most people are focused on filling buckets. They pour money into 401ks, 529s, savings accounts, static containers. They measure success by how full the bucket gets. But wealthy families don't build buckets, they build pipes. And not just one pipe, 3 specific pipes that connect to each other. The storage pipe, the velocity pipe, and the multiplication pipe. Once you understand how these 3 pipes work together, you realize that almost everything you've been told about investing for your kids is optimized for financial institutions, not for you. Let me start with the storage pipe, because this is where most people completely misunderstand the game. You've probably heard about whole life insurance being pushed by some guy in a cheap suit who wants to hit quota. And yeah, 90% of whole life policies are garbage sold by commissioned salespeople who don't understand the product themselves. But here's what nobody explains. When structured correctly by someone who actually knows what they're doing, and I'm talking about a fiduciary who earns fees, not commissions, a whole life policy becomes something different. It becomes a tax-free storage vault that grows, that you can borrow against, and that keeps growing even while you borrow from it. Here's how it works in practice. I fund a policy for my daughter. Let's say I put in $50,000 a year for 5 years. Total input, $250,000. That money sits in the policy, earning a guaranteed rate plus dividends. Boring so far. But here's the interesting part. The policy has a cash value that grows tax-free. And unlike a retirement account, I can access that cash value anytime by taking a loan against it. Not a withdrawal, a loan. The insurance company loans me money using the policy as collateral. And while I have that loan out, the full cash value continues to grow as if I never touched it. This is what the wealthy figured out decades ago, and what nobody bothers to explain to the middle class because there's no commission incentive to structure it properly. Now you might think, wait, if I'm borrowing money, don't I have to pay interest? Yes, typically around 5%. But here's where the math gets interesting. And this is the part where people's brains short circuit. If the policy is earning 5.5% on the cash value, and you're paying 5% on the loan, the net difference is 0.5%. But you're paying that interest to yourself, not to a bank. The insurance company doesn't keep it. It goes back into your policy's dividend pool. So you're basically paying yourself interest while your cash value continues compounding. It's not that you're gaming the system. It's that you're becoming the system. Let me give you a real scenario. My daughter's 25. She wants to start a business. She needs $100,000. If that money is sitting in a 529, she can't touch it without penalties unless it's for education. If it's in a Roth IRA, she can withdraw contributions, but not earnings, without penalties before 59 and a half. If it's in a taxable brokerage account, she has to sell assets, realize capital gains, and pay taxes. But if it's in a properly structured whole life policy, she takes a policy loan. The $100,000 stays in the policy, still growing. She pays interest back to the policy. And when the business generates cash flow, she can either pay the loan back or let it ride, because the death benefit will settle it eventually anyway. Same money, 3 different moves. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here's where most people stop thinking. They set up the storage, maybe they get the tax advantages, and they call it a win. But that's only the first pipe. The second pipe is about velocity. How many times can the same dollar get put to work before it stops moving? This is the concept almost nobody understands. And it's the reason some families build dynasty-level wealth while others plateau at comfortable. There's a story about 2 farmers. Both inherit land. Farmer A plants corn, waits for harvest, sells the crop, and puts the cash in the bank. Each year he repeats: plant, harvest, sell, save. Farmer B plants corn, harvests, but instead of selling all of it, he keeps some to feed livestock. The livestock produce milk and meat. He sells those for more than the corn would have fetched. Then he uses the manure to fertilize the next crop, reducing costs. Same land, same initial seed. But Farmer B's dollar moves through multiple systems before it rests. That's velocity. In financial terms, velocity is how many jobs your dollar performs. Most people think investing is binary. You either save cash or you invest in stocks. But there's a third option that almost nobody talks about because it requires actual work to access private credit. This is where you're essentially acting as the bank, lending money to real estate projects or businesses secured by assets and getting paid interest while you wait for the next big opportunity. Let me be specific. Right now, in early 2026, you can put money into private credit deals, typically short-term loans secured by real estate, and get 8 to 12% annual returns. These aren't Ponzi schemes. These are bridge loans to developers who are buying a property, renovating it, and refinancing it within 6 to 18 months. The loan is backed by the property itself. If the developer defaults, the lender forecloses and sells the asset. You're first in line. The risk isn't zero, nothing is, but it's a hell of a lot more transparent than hoping your stock picks don't crater because the Fed tweeted something. Here's the kicker. While that money is earning 10% in private credit, it's simultaneously building up cash value in the whole life policy if you structured the funding correctly. You're getting paid twice, once from the credit deal, once from the policy growth. This is the velocity pipe. Your dollar isn't sitting idle. It's doing 2 jobs at once. Now, this is where it gets really interesting. Because the third pipe, the multiplication pipe, is where generational wealth actually happens. And it only works if the first 2 pipes are functioning. This is the private real estate game, not single-family rentals where you're dealing with clogged toilets at 2 a.m. I'm talking about multi-family real estate apartment complexes with 50, 100, 200 units. And I'm specifically talking about investing passively as a limited partner with an operator who knows what they're doing. Here's why multifamily is different from almost every other asset class. A single family home is valued based on comparable sales. If your neighbor's house sells for $300,000, your house is worth about $300,000, regardless of how nice your kitchen is. But multifamily properties are valued based on net operating income. It's a business. If you own an apartment complex generating $1 million in NOI, and properties in that market trade at a 6 cap rate, your property is worth $16.6 million. If you improve operations and increase NOI to $1.2 million, your property is now worth $20 million. Same building. You just raise rents, decreased expenses, and added value. This is why operators who know what they're doing can manufacture returns that sound impossible to people who only understand stocks and bonds. I'm going to give you a real example with real numbers because this is where theory becomes reality. Let's say you invest $250,000 into a multifamily syndication. The operator buys a 200-unit apartment complex in a growing Sunbelt market, let's say Georgia or Texas. The property is undermanaged. Rents are below market, deferred maintenance. The operator's plan is simple: stabilize operations, raise rents to market rate, improve expense ratios, and either refinance or sell in 5 years. Here's the math. Year 1, you get a 7% cash on cash return. That's $17,500. Year 2, 8%. Year 3, 9%. Year 4, 10%. Year 5, 11%. Over 5 years, you've collected roughly $47,000 in distributions. Not bad. But here's the real money. At the end of year 5, the property sells. The operator has increased NOI from 1.2 million to 1.8 million. The property that was purchased for 18 million is now worth 27 million. After paying off the mortgage and closing costs, there's a surplus. Your initial $250,000 investment returns approximately $490,000 at sale. Add the $47,000 in distributions, and you're at $537,000. You more than doubled your money in 5 years. That's a 15% internal rate of return. Now here's what makes this the multiplication pipe. You didn't manage a single tenant. You didn't fix a single pipe. You didn't even visit the property. You just placed capital with a competent operator who had the expertise, the team, and the deal flow. And because the investment was structured through the whole life policy, meaning you took a policy loan to fund the deal, your cash value kept growing the entire time. You doubled your money in real estate while the policy compounded in the background. That's multiplication. But you might be thinking, okay, this sounds great for one deal, but how does this become generational wealth? Here's the answer, and this is the concept that changed everything for me. It's called the forever 5-year double. Someone way smarter than me explained this, and once I understood it, I restructured everything. Here's how it works. Instead of putting $250,000 into one deal today, you put $50,000 a year into a new deal every year for 5 years. Year 1, $50,000 into deal A. Year 2, $50,000 into deal B. Year 3, deal C. Year 4, deal D. Year 5, deal E. Now stop. You've invested a total of $250,000 over 5 years. You're done contributing new capital. But here's what happens next. In year 6, deal A matures. Your $50,000 has doubled to $100,000. In year 7, deal B matures. Another 50 turns into 100. Year 8, deal C. Year 9, deal D. Year 10, deal E. By year 10, you have $500,000, but you haven't stopped. You took each $100,000 return and rolled it into a new deal. So in year 11, the $100,000 from deal A's second cycle doubles again to $200,000. By year 15, you're looking at multiple $200,000 positions maturing. By year 20, if you never added another dollar, you'd have over $2 million in play. This is how you manufacture generational wealth without trying to pick the next apple. You're not speculating, you're not timing the market. You're just systematically placing capital with competent operators who can manufacture returns through operational improvements in real assets. And because the deal flow is consistent, because there are always apartment complexes being bought and sold, the system perpetuates itself. The 3 pipes work together. Storage in the whole life policy, velocity through private credit while you wait for deals, and multiplication through real estate syndications that double every 5 years. Now here's the part nobody talks about because it's uncomfortable. This system requires initial capital. You can't start with nothing. If you're at 0, this isn't the play. You need to build the first pile of cash through earned income, through business, through grinding it out. But once you have $50,000 to $100,000, you can start building the pipes. And once the pipes are built, they run without you. Your kids inherit a system, not just a pile of money. They inherit deal flow, relationships with operators, a structure that keeps compounding. That's the difference between leaving your kids $1 million and leaving them a machine that produces millions. Let me hit you with 3 takeaways. First, stop optimizing for tax-deferred accounts if you're already maxing out employer matches. The tax savings are a mirage if the money's locked up until you're 60. Build liquidity and control first. Second, if you're sitting on lazy cash earning 1% in a savings account, you're losing 4 to 5% per year to real inflation. Move it into private credit. Move it into short-term notes. Move it somewhere that pays you while you wait for the next real opportunity. Third, stop buying single-family rentals unless you want a part-time job as a landlord. The wealth is in multifamily, and the only way to access it without becoming a full-time operator is through syndications with people who actually know what they're doing. Lazy investing built more fortune than crypto memes. The families that win don't chase. They build pipes, they let capital flow, and they let time do the heavy lifting. That's it.